Welcome to Crypto for Planners. I am Steve Larson, and with me is Adam Blumberg. And today we are going to cover what's going on with the banks and in the economy. Adam, how are you feeling about everything that's going on right now?
Steve, I am feeling okay considering, kind of teetering on the brink of financial collapse. But other than that,
Is that the economy or you personally that's on the brink of collapse?
the answer to that is yes. It is. It is actually both. Both are kind of teetering right now, but that's okay. It's where we are, and you and I are here to chat about it.
Yeah, we are. So what we're not going to do today is really give you a thorough recap of what happened. That's already been done much better by better journalistic outlets than Adam and I talking on a Zoom. However, for those of you that need to be brought up to speed, there were three major bank failures here in the last several weeks. They were all coincidentally crypto related for various reasons that we may get into. And so really we want to cover what's going on. Obviously, it's spread into some concern over bigger contagion that's going on. But we really want to talk about what's going on with these three banks and how it might affect advisors.
Right. And so, important note there is the middle bank in there, right? Silicon Valley Bank was actually not much of a crypto bank. It was a tech-centered bank. It was created, basically to service those companies that were getting VC funding mainly in the Silicon Valley area at first, but really those companies that were getting VC funding in the tech arena. And so they were actually notoriously not a crypto bank. They did not like banking crypto-related companies. They liked banking kind of Web2 related companies, fintech, those kind. So that the middle of the three banks was really not a crypto related. And remember, the first one wasn't a total failure. It was a bank that just wound down operations because they said we're not going to have enough money if we don't wind down now. And they gave, and that's Silvergate I'm referring to, they gave everyone their money back. So again, I know we're not trying to recap everything, but when we see headlines, and this is how it affects advisors, right? Your clients see headlines about bank failures and bailouts and everything. And that's really not what we're seeing here. We didn't have a full-on failure from Silvergate. They wound down operations and we can go into the fact that they had a loan from the Federal Home Loan Bank kind of pulled out from under them, but they gave all their depositors their money back and got rid of operations. And with Silicon Valley Bank, it was just a run on the bank that didn't really need to be there. And then with Signature Bank in New York, that one's kind of up in the air.
We still don't know.
We still don't know. The Fed is calling it a failure, and we had to take it over. And I'm a little leery of that.
Yeah, it was shut down via press release. It would appear without much more of a formal process.
Exactly. Yeah, it's one of those things like if you're a baseball player and you find out you got traded because someone sends you a tweet or something. It was kind of like that.
Very, very similar. I know that I had some thoughts on it over the weekend, and I think you may have summed it up in a tweet. It was something to the effect of, "Is this the dumbest bank run of all time?"
Yep, that sounds about right. It was an incredibly dumb. It was, and what I kind of intimated to you earlier today, and I think I said it on Twitter, is so many people that I don't know. There are so many people that I know, and I'm relatively privileged, right? I have people, all my friends have gone to college and they're doctors and lawyers and in business and such. They still don't understand how fractional banking works.
Yeah.
And they don't understand the inverse relationship between interest rates and bond prices and how that works. So when they start reading headlines, and these people are your clients, right? They're the clients of advisors in Planner now, they're the clients of advisors we talk to. They're reading these headlines going, oh my gosh, there's a banking crisis. Mm-hmm. And the reality is there's really not I don't understand what the crisis is.
Yeah.
Right. That's the trouble. But it's one of those things as a bank run starts, once it starts, it just keeps going. It's kind of self-perpetuating.
Mm-hmm. Ends up being a crisis of confidence more than anything. And let's move over to that. Let's move into how it does affect advisors and how a potential change in the macro environment is going to affect practices. So, for example, yesterday, so we met with my RIA. We met with the team on Sunday. We decided to get something out to the clients on Monday just because there was so much bad information and so many scare tactic headlines. As you know, I'm not a big Twitter person, but I made the mistake of getting on there for about 20 minutes, and I thought the world was collapsing. Then I remembered why I stay off of there. But what we did, so we put on a webinar for our clients, and really the focus was, of course, here's what's going on. But we spent a lot of time going through basically the different types of accounts. So you mentioned how people don't understand fractional reserve banking. Well, we wanted them to understand what a bank account is, how they don't have all the deposits on hand to cover the clients. And also the FDIC insurance that's tied to that. What does that mean? And then over on the brokerage side, that's not fractional reserve. So they're supposed to be your assets that aren't loaned out or borrowed against or anything else. Now, whether that's the case, that's a different story, but that's at least theoretically how it works. And then there is SIPC insurance on that and how that works. So that's kind of where we started at our firm.
Yeah, and that's a great place to start for any advisor, is to just kind of help your clients understand, and then you can move forward from there. And once they have a better understanding, then you can move forward and go, all right, we can talk individually with all of you about where your accounts sit, what kind of risks there are in those accounts, because that's your job as the advisor, is to know about these things and then to help them through it. So that's a good place to start, is not to go full on Twitter, all caps, this has to stop, or you have to hate the government, or everything's falling. But let me just explain to you how all these work. And then if you need to come talk to us, which you probably did, if you need to come talk to us about it, you can schedule an appointment and we'll talk about your different accounts, whether they're at banks, whether they're brokerage accounts, wherever, and what they mean, what kind of risks there are, whose money it is officially.
Yep.
And, let's have those discussions. And as I said, most people don't understand how all that works. So if you just explain it to it, and your job as the advisor is that first line of education, then that's a good place to start.
Yep. Now what if people, what if clients started with where I started with, right? Like, there's a run on crypto banks. They're after the crypto banks. This is about crypto, and it's not about crypto at the same time. So that gets a little more confusing. As far as the bank fundamentals, I certainly don't think so. But as far as the crypto banks being targeted, yes. So where do you think crypto, as it relates to advisors, fits into this scenario here?
So the hard part is, as we've seen, it very much seems like the crypto related banks are being targeted by the government, right? And there's plenty of stuff to read. There's plenty of stuff that is conspiracy theory, and some of it that is probably not at all conspiracy theory. That is the crypto banks or the crypto industry, I guess, is being targeted. And one way you target that is you go after the banks that are banking the actual companies. And those companies being exchanges, those companies being, like Circle, which offers USDC or US dollar coin. You start targeting those banks and saying you're no longer allowed to exist. And therefore, all your depositors have to get their money back, and they got to go find another bank. And eventually, crypto companies run out of banks, run out of places that they can hold their money. So where it comes down to affecting clients is you go, all right, what do we feel is the US government's attitude toward crypto? It's obviously this current administration is a negative attitude towards crypto. Where does that affect? Then where does it affect your investments in crypto prices? Well, kind of what we saw is prices went down for a little while in terms of Bitcoin and ETH and the other crypto assets, and then they have taken off the last few days. Now, whether that's because the tough part to know is that because the government, quote, averted a banking crisis and we're all happy that we're not all losing our money, or is it because we're starting to realize the cracks in the banking system and the cracks in the financial system and go, oh, maybe this is part of the solution. And therefore, there's going to be more usage of Bitcoin and usage of Ethereum. And it could be a combination.
And it makes you wonder, are we shifting from an attitude where, hey, the government's coming after crypto, crypto's in trouble, to, hey, the government's coming after crypto, crypto's super important, because really they know they're not just coming after crypto, they're coming after your economic freedom. And now it's more important. And that's certainly the optimistic take, but I think it warrants watching. As the government goes harder, does the adoption increase and the price increase because of that?
Right, exactly. And we can go that route, which is kind of the conspiracy theory route, which I don't feel is very conspiracy theory anymore. I think they've made it pretty obvious. But if the route is, I don't like the fact that I'm subject to what happens with the banks, and therefore I'm subject to what happens with the central bank and the Fed, there's a way to opt out of that. It doesn't have to be with everything, but with some of your money, there are ways to opt out. And the way you opt out is you hold on to your assets. And that's exactly what crypto is. It's, I'm going to take care of my own assets. So it could be, I'm worried that the government's going to have full, purview over everything I do, and full visibility into everything that I spend my money on. Or it's, I'm not so much as worried about that, but I kind of want to have some of my assets where I have full control over it. And that's what the education for clients, right, about how fractional reserve banking works and about how your accounts work is, once you've handed the money over to the bank, you're kind of not in full control. And if you want to have this full control, once you understand that, you go, and they're probably going to go, all right, how do I get control of my assets? Well, that's kind of what the crypto system is building. It does have a lot of warts right now. It's not the easiest user experience, all of those things, which are getting better. But at least for advisors, you kind of see now why there's a need for it. And maybe now is the time to start learning about it. And we're going to, totally self-promotion here, but that's kind of what we're trying to do here. But this maybe is the time to learn about it, because maybe now the system, it makes a little more sense. And even if you weren't behind some of the speculation behind the price of Bitcoin, now you kind of go, oh, well, I see where the idea of custodying my own assets, or my clients wanting to custody their own assets, kind of makes sense. This is a system that does that.
That's well said. And one of the practical effects, on the RA firm was the switching of the banking partners. So obviously getting money on and off, in and out of the accounts. My firm's at Gemini Vitria, and so they were processing wires through Silvergate, and then it changed, and then now I think it's JP Morgan or something. Don't quote me on who they switched to, and again, and I know another great provider in the space for advisors that, again, they've been fine through all this. He's a great custodian, but they've had to redo the banking provider and the off and on ramp a couple times, and it's just been a pain in the butt. So it wasn't any funds at risk, but certainly operationally and logistically getting money on and off was affected throughout this. And Adam, let me use that to transition into the last thing we want to talk about, which is, what does this mean for DeFi and self-custody that you mentioned? And I use those to link it, because the choke point in both places is the on-ramping. It's getting money out of your bank into crypto. And that's the first thing that needs to be tackled if we're going to really go any direction, but specifically into DeFi.
Where it leaves DeFi is, it's hard, because you're right. The on and off ramps are the tough part. We still pay for most of our stuff in dollars. We still mostly get paid in dollars, whether it's your business, whether you're an employee, whatever, you generally get paid in dollars. And you, at some point, if you want to participate in the DeFi system, have to convert that into crypto. So I think it leaves us, honestly, in some tough points. Coinbase is still, kind of the biggest on-off ramp here in the US. And it's going to be really tough for the government to put a clamp on Coinbase, because they're a publicly traded company, because everything's really pretty transparent. And it's, at some point, you can't just basically snuff out an entire publicly traded company.
Yeah.
So I think that's, Coinbase is still there. And going a little bit further into where it sits with DeFi, the things that Coinbase released in the last few weeks, right, which is their base, which is their layer 2 on top of Ethereum, their wallet as a service product, code, whatever it is that's coming out, which is basically, now I'm going to have this on-ramp on a Coinbase, and then probably more easily move that into DeFi on chain, as we say it. I think those are pretty important. And the fact that Coinbase is still there, and Coinbase is moving these things forward, not to be like an advertisement for Coinbase, but again, being a publicly traded company, and having the relationships they have, and having the amount of money they have, they're kind of the bellwether right now. They're kind of what we're all looking for as far as the on and off ramps. And then you get into DeFi. That's probably the on off ramp. Eventually, we probably see us more of earning money on chain, meaning I'm going to earn in crypto. I'm going to get paid from my company's wallet to my wallet, or my company's crypto account to my crypto account. there is probably going to be more of that, and more of that, UX is being built and more of those products are being built. And again, as the advisors, it's going to be kind of incumbent to understand how all that works. If my client's getting paid in crypto, I better understand what that means and how to take on those risks. Because honestly, before last week, would you have even thought about the risks inherent in your bank accounts at federally chartered banks?
No, I wouldn't have. And I don't think most people were. And part of, like I mentioned, the education we did for clients was, hey, within your Schwab account here, we can put it at CDs at 10 different banks if we need to. We can get it diversified out. We can stay under these limits, because even though it's unlikely, it's still, why not? Like, why wouldn't we be more safe than not in doing that? And you bring up a good point about Coinbase. They are aligned with us as much as possible, with people who want crypto to succeed, because they're not a fractional reserve bank, and they do segregate assets, and they are regulated, and they're kind of the best of all worlds. And to somebody like Gemini's credit, so are they, except, right, they were trying to generate yield from a black box and got in trouble with the Earn product and all that. But as far as segregating the customer's assets, specifically on the institutional side, they do it as well. But that's looking more and more attractive by the day, right? At least have your assets in an institution where they can't lend them out or chop them up or pool them together.
Exactly. And as the advisor, having to do some of that due diligence, right, on not only the custodian you're using for your clients for crypto, but on who they do business with, who their banks are. Like if you keep going down the line, where are the risks further and further down the line? And you might, as the advisor, throw your hands up and go, well, I just don't want to get in this crypto thing. I'll just stick to traditional assets. Well, look, banks got hit, right? Like who's to say there's not a run on, some other bank? Who's to say there's not more that's being created, more that we're going to see in the near future? I think, I don't know if we've mentioned Fidelity. There's Fidelity as a custodian, there's Fidelity as a bank as well, right? So everyone's going to be impacted by what happens next with what the Fed does and what the federal government and central bank do with banks, because all of our money is so intertwined. So it's an important wake-up call to go, all right, it's time to start doing a little bit of risk management, a little bit of due diligence, more so than we did in the past, where we just said, we totally trust that the government has it under control, and go, all right, we need to find out where those risk points are. And going back to the idea of Gemini and Coinbase, like, okay, we need to do that kind of risk assessment and due diligence as advisors, just like you need to on all of your custodians.
Yep. And Fidelity's a great bridge between the two worlds, right? They are legitimate crypto custodian, and they're obviously, a top 2, 3, 4 legit traditional custodian for advisors, and they're in both worlds for sure. And there's somebody, again, that can serve as a great on-ramp between the two worlds, and they're not doing a whole lot of it now. And the reason is because of this regulatory uncertainty and the attacks that they see Coinbase take and that these banks are taking, and who knows what's going on behind the scenes there. But at some point, we're going to need these larger companies who understand both worlds to step up and fight for crypto, hopefully.
Yeah. And I think they will. And if we could go back a little bit, I think, and I apologize for continuing to go back, but where we started this conversation a little bit is what is the impact on these, quote, crypto banks, or these banks that were happy to bank crypto companies, getting shut down, and advisors talking to clients and this feeling of, oh my gosh, the government's trying to shut down crypto, there's no more banks. Well, you just mentioned Fidelity is a pretty large traditional finance bank, a pretty large traditional finance custodian, and a pretty large crypto custodian, and is getting bigger every day, and delving into that a little bit more. Chase, I mean, as much as Jamie Dimon talks badly about crypto, they still do quite a lot of banking for crypto companies. And let's not forget, Bank of New York Mellon, which is maybe the largest custodian in the world, is they're the custodian of choice for a lot of huge crypto hedge funds and banks. And I don't feel like, and I don't want to make assertions, but those companies aren't going down anytime soon. Those are not banks that are going to fail anytime soon, because they're the too big to fail banks.
Yep.
Right. And they're all full on into crypto. They're not backing away at all. They're custodying assets, they're custodying digital assets, traditional assets, they're mixed. So I don't want there to be this feeling of, oh my gosh, they shut down Silvergate and Signature. It's all done, because there are much larger banks than those two that are perfectly happy delving into crypto.
Yeah, I think my overall take, and it's a topic for a whole other podcast, but it's not that they're trying to kill crypto, it's that they're trying to control crypto. And these are smaller, more independent banks who maybe don't have the revolving doors of people moving from the board of directors and general counsel through the Treasury Department back to the banks like the bigger ones, where they do have control. So I would say it's more of a wanting it under their thumb than a let's kill it altogether type of attitude coming out of the government.
Yep. Yeah, I agree. You're right. It's more of a control. How can we control it than kill it? And if we need to tamp it down a little bit till we figure out how to get control, that's probably where we are at this point. But again, there's plenty of business to go around. There's plenty of building that's going on in the crypto world. And we're seeing every day more needs for solutions like this, not to totally take over the traditional finance system and kick it out of the way, but you see a little bit here and there as to how I can take on some of that custody and take on some of the things that crypto gives us: the transparency, the instant settlement, the self custody.
Yep, great summary. So let's go ahead and wrap it up there. It's enough bank talk that I think anybody should be subjected to in one sitting. Hopefully there's some value there for you. Let's end with a pitch. You're going to hear from us a couple times. The pitch is to go to Crossroads. Crossroads 23, the Planner DAO conference in St. Louis, last week of April, Monday, Tuesday. Is it 24th, 25th? I should have had that up, something like that.
Yes, 24th and 25th.
In St. Louis. Come get your tickets. And most importantly, Adam, maybe people don't understand the speaker lineup we have, and that's why they're not buying tickets.
Yeah, I'm not quite sure. Like, it's a pretty killer speaker lineup. So you and I have talked about banks and compliance and regulation and stuff. So we have Commissioner Hester Peirce is leading off our conference. So we're going to get to ask an SEC commissioner, have her talk about what's happening with compliance and regulation for the SEC, which is pretty important to us as advisors. And we're going to get to ask questions. After that, we have Matt Hogan from Bitwise, who's going to talk about the state of the market. We're going to have a compliance panel with compliance attorneys and compliance officers, where, again, it's all discussions. You get to ask questions. And if you're an advisor that's into crypto or wants to be, in 2 days, you're going to get just about everything answered that you want. We're going to have Tyrone Ross and the 401 Financial crew that's going to talk about how they're building kind of the RIA of the future using certain tools, some crypto, some not crypto, some are just Web 2 and kind of new tools that are out there. So there's so many others. We're going to talk about data and research and where you get your information and indexes and all of that. But it is an absolutely killer lineup for any. It's very focused on advisors wanting to add crypto to their practice.
Yep. Hit plannerdao.com/crossroads and you can get the details on time and date, hotel, and buy your tickets. We are using NFTs for tickets. We'll try to get sidetracked explaining that, but no, you don't have to pay with crypto. Yes, even though we're doing NFT tickets, you can pay with your credit card specifically, and hopefully your company's credit card. It makes it a lot easier on everybody. All right. Adam, thanks for jumping on the podcast with me. Hope there was some value there.
All right. Hope so. Thanks for having me.